program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. I can't tell you how good it is to hear that theme music back on the network again in regular rotation. It's really great to be doing Vol Views every week, just like old times again. My name is Mark Longo from the OptionsInsider.com, as well as from the old Options Insider Radio Network, upon which many of you are listening to this fine program right now. And if you like this show, and if you like to delve into a little bit more of the hardcore, wonky stuff going on in the world of options and derivatives, and we have a new show coming down the pike that may interest you. It's called Trading Tech Talk, and it breaks down all of the interesting technology that goes on behind the scenes between when you click your mouse and when the trade actually gets to the broker, into the clearinghouse, and back to you for reporting, and all of the super hardcore stuff that goes into that: messaging, bandwidth, colocation, execution, all kinds of crazy stuff. It's really, really interesting, really, really hardcore. And it really breaks down all the kind of stuff that goes on behind the scenes in the trading world. So check that out. That will be launching sometime in the next week or so. So stay tuned for that. But of course, right now it's time for the premier program for volatility traders. Of course, Volatility Views. And joining me on the program today, you may remember him from his recent guest appearance on the show, but he's been brave enough to join us today as a full-time host for today's episode. So he's diving into the deep waters. Of course, I'm talking about Russell Rhodes. He is a senior instructor over there at the Options Institute. Russell, welcome back to the program.
Oh, Mark, thanks for allowing me back on so quickly. I appreciate the opportunity to talk about VIX anytime anybody wants to allow me to do so.
That's why we like having you on this program. Wind you up and you can talk about VIX for hours, which is a great thing for radio. And it is kind of fitting that you are the first person to actually fill in on the Russell Investments hot seat on the program, if you will, since your name is Russell. It's very, very, very apt.
That, or it can be a little bit confusing. Sometimes when I'm doing classes, I will attempt to make a joke about trading Russell indexes being my favorite indexes, and inevitably I'll get a couple of follow-up emails asking why it is I like the Russell indexes so much. And it just apparently flew right over a couple of people's heads.
Kind of falls flat, huh?
Yeah. So.
All right, and now it's time to dive into our first segment, the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the program where we break down the week's worth of action and activity across the volatility trading landscape. And it was a bit of an interesting week. We saw a bit of some action earlier with some sell-offs, and then toward the rest of the week it kind of has been pretty much par for the course, where we saw essentially vol tapering off. We are recording this on Friday, January 17th. So we're heading into a long weekend right now, the Martin Luther King holiday weekend. So as expected, we're seeing vol come in and seeing people, market makers, taking advantage of this opportunity to squeeze out any last bit of decay they possibly can. Of course, as is their wont on holiday weekends, they actually started that process yesterday. So they've been squeezing the juice out for quite a while. In general, Russell, does I guess you can call it the general vol malaise that is going on right now here in the beginning of Q1 and the beginning of the new year, does that surprise you at all? Is that kind of pretty much what you expected?
You know what actually surprises me a bit? Well, first off, I just came off the trading floor and saw multiple people walking out with coats on and backpacks. So even with a couple of hours left
one of those
the trading
days.
day, you're right. They're taking off for the early weekend. One of the things that kind of surprises me is as we speak, VIX is only off 3 cents with the market under a little bit of pressure, but VIX is higher this Friday than it was the previous Friday. Last week, it actually went out closer to 12. I'm trying to dig up the number, around 12.14, and right now we've got it at 12.50. And anybody that pays attention to VIX knows that when you're going into a long weekend like this, you usually see some extra compression on the index, and it's just not there. If I had been forced to guess over or under on 12 today, I actually would have guessed 12. Under 12, and we're 50 cents above 12 right now. The other thing that kind of has me scratching my head is January expiration is next Wednesday on the open. So right now we've got a couple hours on Friday and a full trading day on Tuesday left for trading January VIX contracts, and the January future is at a 90-cent premium to the underlying VIX index, and the Russell volatility futures are at even greater premium relative to the underlying index going into just one more day for January trading.
That is odd, and of course, listeners may be new to the products. We usually expect that compression to happen on a much faster scale than this. So it is kind of interesting to still see that there still is so much premium going into the final days there on those contracts. And it's been an interesting time, I think, just in general, to watch what's going on in vol. We, of course, had a lot of interesting developments towards the end of 2013. A lot of people were banking on the Fed and Bernanke maybe injecting a little bit of vol into the marketplace. But beyond that, and certainly going into Q1, there weren't too many predictions going out too far that showed anything that had any remote possibility of injecting any lifeblood, any real vol into this marketplace. We started the year with some aggressive 1% or so sell-offs, but those primarily seem to be tax-driven for the most part. I think the options flow kind of correlated that by showing that even though the market was selling off somewhat aggressively, people weren't scrambling to lift offers on some protection. People weren't bidding up vol. Vol was still pretty much staying relatively unched, if not underperforming, given the dramatic level of the sell-off. So it really didn't seem like people were scared by those sell-offs. It was kind of just business as usual, taking some profits to pay for some of the other activities and other gains they had earlier in the year. So when you take that stuff out of the equation, it really has been kind of a ho-hum period for vol so far. I know on our option block program, when people were prognosticating towards the end of the year and what they were looking at for vol going into Q1, and pretty much everyone agreed that it was looking like it might even be single-digit time for the VIX cash getting at some point into Q1 before we finally get back into the big governmental debates into March and that time frame again.
It's interesting you bring that up because we're just not seeing that grind lower. We haven't had a new post 2008 low in VIX for months. And that's despite the S&P 500 continuing to make new highs on a fairly regular basis. You would think that we would continue to see a grind lower. I'm starting to really wonder, and this is going out on a limb because we could have VIX closing at 950 next Friday after some great earnings or something next week. But it's starting to feel like the 12 level is 12, and then maybe just a couple of dimes lower are is just the low that we're going to see in volatility. That's the new norm end of or bottom part of the range, because it has been for months. I think our low was 1180 in last May, if I've got that right in my mind.
Yeah, you're right. It seems to have found a little bit of a floor, at least in the near term there, in that high 11s, low 12s type of range. And even though a lot of people are kind of thinking that it might drift lower in the near term, certainly a lot of people are hedging or betting that it may indeed pop again in the near term as well. In fact, VIX is always call heavy on the open interest anyway, but right now it's really hitting some all-time highs in terms of just sheer numbers of calls open out there. As of yesterday, there were 7.8 million calls open on the VIX options. That's the most in about 10 months. That gives us a call to put, not put to call, listeners, call to put, flipping it around, of about 3-1, which is pretty high even by VIX standards. People normally just flock into calls all day in VIX, but 3-1 is pretty aggressive. Does that surprise you, given what was otherwise the prevailing sentiment that we're kind of just going to keep drifting lower here?
It surprises me in a couple of ways. One, just the fact that even though we're at a very low level, you're seeing some aggressive call buying. In fact, I'm looking at a list of index block trades from yesterday, and the 13 biggest index option block trades were all in VIX, and 12 of the 13 were in calls. So it shows that people are either trying to take advantage of the low VIX environment to maybe buy some. I'm looking at, it looks like February, March, and April's were trading fairly well yesterday on Thursday. The other part that kind of surprises me when you throw that out there is it seems like, not that VIX traders haven't always been very sophisticated, but I've started to notice that VIX traders will be sellers of maybe an out of the money put, and turn around and take some of that premium with the assumption that the 11 or 12 range is a floor for VIX, and use that premium to buy calls. And we've actually seen, I think, a trend to where the call to put ratio, as you put it, has compressed somewhat. I feel like that kind of activity has also had some compression on the VVIX. So, it's a combination of, you don't hear anybody talking about some sort of known unknown that's going to, trip up the markets, which is something we sort of lived with for almost 12 straight months, and that there seem to be more spread trades going on. It's very possible that, with the compressed VVIX, nobody's seeing value in selling a put right now to try and buy a call. So maybe that's why that ratio spiked up a little bit.
Yeah, you're right, because normally if you'd be seeing risk reversals accounting for the lion's share of this volume, it should be somewhere close to 1-to-1, unless people are really putting on a lot of ratio risk reversals. That could certainly be the case, taking advantage of some downside premium to buy a lot of cheap upside on some ratios, and that could certainly account for it as well. It's interesting you mentioned Feb block trades going up. It seems like February, for whatever reason, people always talk about October being the crazy month in the market, but it seems like for VIX and VIX options in particular, February is where some of the craziest paper we've seen has gone up. If you remember, I think it was about a year ago, we saw someone flocking in to buy 20,000 of the Feb 70s. Crazy things. Yeah, crazy things tend to go up in February. And I'm just looking at some of the Feb open interest while we're talking here, and it still seems there's still some shall we say, aggressive folks out there, because there's 41,000 open on the Feb 40s, which is over 300% gain in the VIX.
Somebody's expecting something.
Yeah, that it gets. I mean, granted, not all of that could be long, but still, just there's size paper open. The 45s, 32,000 open. You don't see that in a lot of the other months, and yet for whatever reason, Feb is where the bulls in VIX really seem to like to play. I don't know why. Maybe there's some historical correlation that I'm missing to VIX spikes in February, but for whatever reason, when the crazies come out to play, they seem to come out in Feb in big numbers.
It's interesting you bring that up. I actually did some seasonal work now that we've got we've had futures out there since 2004, and we've had the options out there since 2006. We're starting to get enough data where you can start to look at seasonality, and February actually is in the bottom half of average VIX levels. The really high months are the ones that you would expect: October, November, September, and December. Right after that, April is actually a month that that's actually at the completely opposite end of the spectrum on that. where we have very low volatility. But the fall months are the ones where we've had the highest average VIX. February is kind of in the middle. So, I don't know if it's necessarily some sort of seasonality or some sort of, maybe there's something going on in the Eurozone that a small country like Cyprus or something's getting ready to have a hiccup that's going to scare us, and we just aren't aware of it quite yet.
It's kind of funny. I've almost just taken it as par for the course now. Whenever I see something coming into our site or on another outlet writing up some crazy trade in VIX options, usually call buying, I just almost assume it's February. unless I see otherwise. I'm like, oh, someone bought some crazy Feb 80s or something crazy, and I just kind of dismiss it. So it's kind of, and it's funny to mention that you're not seeing the correlation you might see underlying to support that. People are just flocking into Feb. Maybe it's just anecdotal. Maybe just the big trades are overwhelming it in February versus all the other little trades going up in other months. But for whatever reason, it certainly seems like February is the home of the crazies.
Well, it's very possible that January is typically not a very difficult month. So, maybe and you're typically, when you're buying call options on VIX, you want to own the near dated call options. If you're not terribly concerned about what is, what's going on in January, but you still want to have some protection, you may just go ahead and skip the month and start and buy February options. That's a possibility.
Well, speaking of Feb, we also look here in across the landscape of volatility. And, of course, since it's launched over the past month, we started taking a look at RVX as well. And Russell, since you're in the Russell seat, I'll let you comment on this a little more. But we were talking on the last episode about how it's only been up for really about a month. It's been a pretty challenging month from a volatility perspective. Everyone's pretty much, and their mother is talking about how vol is going to come off endlessly. Kind of a difficult environment in which to launch a new volatility product. And yet the uptake seems to have been decent on the RVX. You talked about last time they have about 33,000 or so. Now it's about 4,000 open interest. And I'm looking today, they did almost 1,000 block today on the Feb 21. So starting to get some interesting paper coming into the RVX. Is that kind of your take as well there, Russell? That given only a month under its belt, it seems to be actually doing some numbers.
It's definitely doing some numbers. It doesn't look like anybody's trying to hit a home run here, but maybe putting on some spread trades. This I'm looking at that February 21 call myself right now, and it does look. I mean, this looks like a pretty aggressive trade where they've actually, they're buying the call, and that's about. I don't see anything on the other side of it. So far, it appeared to me that there were a lot of maybe credit spreads that had come in that kind of testing the water, seeing how the market trades, just a relatively low risk way to get a feel for how RVX futures are going to behave relative to the index. This is that 1,000 lot that you just mentioned. That's that looks like somebody's expecting a spike in the RVX over the next few weeks. So it's a
pretty aggressive
different sort of trade.
Yes, that gets back to my narrative of the size crazies like to play in February. And they're apparently spilling over to RVX as well. But it's interesting to see some big blocks. You're right, not much open on that strike otherwise. So this guy is opening some sizable paper, getting it about mid-market, looks like most of them went up 850 or so, went up for about 70 cents. So splitting the difference there. Interesting trade. We'll have to keep an eye on that one. And just in general, seeing how people are starting to use RVX. I know you guys just did a big volatility seminar over there at the CBOE, including VIX and, of course, RVX. Are you getting what kind of feedback are you getting so far from people interested in that? What kind of use cases are you seeing people outlining for RVX? Is it still pretty much the standard, speccing and hedging for to the vol upside with calls for the Russell 2000? Are people starting to maybe try to lay off some IWM risk? What use cases are you seeing emerging out there?
I think a little bit of both. There are some market participants that are tied to the performance of the Russell 2000, and they want to hedge that volatility. Last year we had a much better year for the Russell 2000 index than the S&P 500, and if it outperformed by, I believe, right around 7 or 8%. So what goes up might come down a little bit harder, and RVX may be a good alternative if you're if you have the exposure or the domestic exposure that you get from the Russell 2000, RVX might be the place that you need to look. On the other side, so far, because with that same mentality, it appears that the Russell futures have been at a little bit more of a premium relative to the underlying index in comparison to VIX. So some of these option trades, I'm pretty certain, that we saw that are actually going to go off the board in next Wednesday, really appeared to be taking advantage of the premium of the future relative to the underlying index, and just selling a credit spread and trying to ride that into expiration. So it's the same sort of strategies. Just maybe looking at RVX as an alternative because of other exposures that you possibly have.
Yeah, and of course, on the surface of it, Russell should be an attractive candidate for premium traders and vol traders in general, because just by definition, small cap should be more volatile than S&P 500. So if you're looking for a place with a little bit of actual bang to its buck, Russell might actually be a decent harbor for you. Now, of course, we're talking here in the Volatility Review segment, and the numbers are in for 2013. So we usually look back on the week's worth of activity. Now we have a chance to actually look back on the entire year's worth of volatility action. And 2013, as you might imagine, was a pretty decent year from an overall volatility trading perspective. Starting on the future side of the fence, the VIX futures ended up in 2013 with an average daily volume for the year of about 159,000 contracts a day. That's pretty sizable. It's up about nearly 70%, 67% from the same period in 2012. We saw options, VIX options, as you might imagine, just lighting up the tape last year. They were up 28% for 2012. The average daily volume in VIX, 567,000 contracts. That's just a stunning and mind-numbing number. I don't know, Russell, maybe you disagree, but when I first heard that they were contemplating VIX futures and then VIX options, I was a former SPX trader myself, and I thought, well, that's interesting. That's going to appeal to the ultra-hardcore of the hardcore, the institutional guys who are going to want to lay off some of their SPX risk, and this is a great way to do it. And conversely, I pity the market makers who have to make markets in this VIX product because they're essentially providing layoff risk for the rest of the pit. And it seemed like an interesting, if not somewhat obtuse and certainly institutionally based product. Never in a million years would it translate with retail. And yet, looking at these numbers, over 500,000 contracts a day, that's just crazy. And that, to me, just shows retail is devouring this product in numbers that are almost mind-boggling. Are you as stunned by this as I am?
Oh, yeah. I can recall when, and I was actually, I was trading financial futures at the time when VIX futures and options came out, and I could sort of grasp trading futures based on VIX, but the option part, my initial impression, and this is 7 years ago, was, why? And I think we now see why, because of the tail risk that you get. So that we're going to talk about some new products that we're going to try to launch here at CBOE in the next few weeks, in a few minutes. But it just leads me to think about any time a new product comes out, it's very much of a crapshoot as to what may catch on and what may not catch on. And VIX futures, I could see it. VIX options, I will admit when I am wrong, and I was definitely wrong on how well VIX options have worked out.
Well, it's good to see that you guys who are dealing with VIX day in, day out, you're steeped in the Kool-Aid, if you will, are still surprised by the numbers you guys have. Because I'm on the outside, and I'm constantly surprised at the numbers VIX is doing. It's good to see you guys internally are still like, wow, look at the uptake on this thing. It is amazing to watch the growth in that, and that of course has really helped to feed just the entire growth of the volatility landscape and the product landscape overall. We don't even have the numbers here for the various VIX ETPs that are related to and driven by VIX, and yet I'm sure those numbers for VXX and others were through the roof as well. Some interesting other stuff just on related products. A lot of our listeners also trade S&P, SPX options. Average daily volume there, 823,000 contracts. That's up 18% from 2012. Of course, you have to keep that in perspective. 2012 was one of the few years, really, where the options industry overall kind of took a little bit of a dip. SPX was down in 2012, down 11%. So if you compare 2013 back to 2011, SPX was only up about 5%. But still, that ADV number, 822,000 contracts, particularly when you take into account the actual notional size of those contracts. Remember, SPX a 250 multiplier, not a 100 multiplier like a lot of these other contracts. So that's just that's some serious paper going up in that product, and it's mind-boggling again to think of the notional value that's going up in that product on a regular basis.
Oh yeah, no, it's it's incredible when we throw the dollar amounts out there of what's going through that pit when we walk people around the floor. It's just sometimes there are numbers that are incomprehensible, and that hundreds of billions of a day, I believe, at times, can really kind of get your mind spinning. But it's a very liquid product, and that's one of the reasons we continue to be able to put up a pretty good volume in that space. And in addition, seeing the growth that you're seeing in SPX, it's even more impressive when you consider that institutions that use VIX options as a hedge for an equity portfolio are often, taking a portion of what they used to use in the SPX arena and applying it to VIX. So, that growth from VIX or VIX options is actually pulling a little bit away from SPX, and it's still, the volume is still growing.
Yeah, exactly. I mean, in many senses, they are kind of cannibalizing each other, and yet both are still exploding, which is really a bizarre and interesting development to watch. Of course, even maybe more interesting, drilling into those numbers a little bit, is just the percentages of the SPX contracts right now, as of last year. Weeklies were just carving up a significant chunk of SPX volume. In fact, for 2013, 27% of overall SPX volume was done in the weekly. So near term becoming a big trend, of course, across the board in a variety of products, but not SPX is not excluded in that number. SPX, people loving the weeklies as well out there. And a couple other interesting numbers I saw that were kind of interesting. We talked last year about extending the hours for the VIX futures. They trade about 14 hours a day now, and it seems to be, at least so far, getting a little bit of uptake, about 67% of the overall volume going up in those extended hours. And the plan, at least from what I heard talking to some of your compatriots this week, Russell, the plan is to add some extended hours for VIX options and SPX options sometime in 2014. So if you're a fan of those hours, maybe you're one of our listeners overseas, then good luck, good news, more hours, extended hours coming your way.
Yeah. Also, we do have the intent of right now. VIX futures open at 2 a.m. Chicago time, which comes, basically is the opening in Europe. There are plans to try to expand those hours to overlap with the Asian market as well. And I know, like in the past year, the Australian exchange has listed their own futures on the Aussie VIX. And I know for a fact, because I'm trying to help them out with this, the National Exchange of India is going to try to launch futures and options on the VIX that is based on the Nifty 50 over there. So you'll have, and there's also already futures trading on the V stocks, on the Eurostoxx 50 volatility index, and we're seeing overlapping. We're seeing spread trading going on between the VStoxx futures and the CBOE VIX futures in the early morning hours.
Yeah, it's interesting to see how those products are starting to feed into each other, which probably wasn't maybe expected in the early days, and yet we're starting to see that develop in the marketplace. A couple other really quick things here that I thought were kind of interesting. A lot of people have been asking about since you guys announced it, when this short term, this VXST, the VIX short term, is going to come into fruition and take advantage of everyone flocking into the short term these days. Looks like the expectation for that is sometime in February, with the futures coming first and then the options probably a couple of weeks later. And that'll be interesting, especially given what we saw over the past trading week or so, where we saw a little bit of a sell-off last week, and then VIX itself not really responding overall. But if we had that short-term tradable product like VXST, that was up, I think, about 31% in that same time frame. So if you're kind of blasé about general VIX, you want a product with a little bit more vol, and you're into the short duration, short-term stuff like the weeklies, then that kind of thing may really be up your alley. So that'll be the sooner the better, I think, for a lot of the listeners of this show, because they want to dive into that product and start slinging weeklies versus the regular options and all the other fun stuff you can do with that.
Yeah, the VXST is, it's a 9-day version of VIX, and we are actually going to have weekly expirations for both the futures and the options on VXST. That's the plan, using the hedge clause here, pending regulatory approval. And I, to put a nice buffer in there, I like to say by the end of the first quarter, which I think should be easily achievable. But VXST, it moves around. They say that, like, that the market is like the S&P 500 relative to the moves you get out of VIX are like a dog wagging its tail, and VIX is on the end of the tail. VXST is like a string that you tied on the end of the dog's tail that whips around even more. I just came up with that analogy, and I like it.
There you go. So. I'm telling you, Russell, you missed your calling. You should be in the marketing department. VXXT, the tail that whips the dog. There you go. I love it. Yeah. All right, and there was a little bit of a long segment, but there's so much to review, particularly when you have a whole year's worth of data coming in to crunch. But we know a lot of you guys have been excited by the relaunch of the show. A lot of you guys are writing in with some great questions. I love to make sure you guys get your time on the show as well, so it's time to kick off the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, and let's get going. A lot of you guys writing in. I want to make sure you all get your time here on the show. First up, a lot of people echoing these same sentiments. I just plucked one of these from the website. This is the comment from a user who goes by the handle nrlbuild, and he writes, "Great to have Volatility Views back on the air. But what about Don Schlesinger? Breaking my heart, man. Keep up the good work, Ned." Ned, a lot of you guys wrote in with the same sentiment, and you're right. The Vol View show was on for nearly 3 years. Don was an integral part of that program. He had a great voice for options, literally and metaphorically, and he was a great part of that show and what helped make it so successful over the years. And unfortunately, as are the ebbs and flows of this business, the product that they were talking about, it was very intriguing theoretically, and yet it was difficult for a lot of the firms in the space to really wrap around and make markets in it and things like that, and all the other vagaries that go into launching a startup in the financial services realm. It's very challenging, as many of you know. And so, unfortunately, we just don't have Don on the show at this time, but we'd love to investigate a way down the road to maybe bring Don and those guys back on the program in some capacity, because they were so integral to the success of the show and to helping it become the big hit that it really is. And thanks to all of you again who just wrote in general to congratulate the show on coming back. I know a lot of you guys have been looking forward to it, and trust me, no one's been looking forward to it more than me in those months of hiatus. They were really, really starting to annoy us here. We really wanted to get Vol Views back on the air because we know it's a unique program, and we know a lot of you guys really, really love it. All right, next up, we have a pretty detailed one. So, Russell, put on your listening ears there, sir, because the listeners of this show, they're a great bunch, and they're pretty hardcore, too, so they like to really get into the weeds. And this question is certainly does that. So here we go. This is a question came in from the website from a user, the handle of Greg, very mysterious handle, and he writes, "I've been looking at the CBOE's put right versus buy right strategy that rolls the at-the-money monthly option short. On the surface, it appears that the put right outperformed with less volatility over the last 25 years. It appears that put right outperforms over longer periods because any or all of the following. Number one, investors have overestimated future dividend payments. Number two, investors have overestimated future interest rates. Number three, the random timing for the call or put being slightly in the money or out of the money during more pronounced market moves. It's important to note that implied volatility should not explain a significant difference here. Both calls and put values are positively correlated with volatility. if you have a taxable account and your underlying holdings are targeted to be held at least 1 year, it would seem covered call would win out due to the stock and dividend being taxed at long-term rates. Put premiums and bond interest are both taxed at short-term rates. Commissions are a slight advantage to the put right strategy, but in the world of online discount brokerages, I would think this is insignificant. Thoughts? Well, Greg, there's a lot to sink our teeth into there on that question. Of course, he's referring to the two indexes that you guys disseminate. The put right, essentially just writing the at the money put on the S&P 500. The buy right writing essentially just the at the money call on the S&P 500, and kind of measuring those different performances over time. And it is interesting to kind of see some of the different performances he's noted here. On the surface, I think a lot of people would attribute that initially to just the inflated level of implied volatility premium in the put wing versus the call wing. In time, you should expect that sort of outperformance, but you wouldn't expect it with a lower level of overall volatility, which is kind of what he notes. And you certainly also, the two are indeed positively correlated, or just indeed correlated to volatility and implied volatility overall. So that shouldn't account for all of the differences that we're seeing here. Russell, have you had a chance to really mull this one over a little bit?
Oh, yeah. This is something I've been asked about before. And basically what you can do is, if you take a look at the institutional world and what they are basically comfortable with doing or allowed to do, you're finding some gaps here that actually result in some market inefficiencies. If you're an equity portfolio manager, and this is an all-encompassing equity portfolio manager statement, and you are charged with beating the S&P 500 in one way or another, you're going to have long equity exposure. Now, and mutual funds will dictate what different institutional investors are allowed to do in their prospectus. Endowments have pretty strict rules that maybe a university president and his board are putting into place. And for whatever reason, options are prohibited from being used by still a good number of institutional investors. In some cases, the first level that institutions may experiment with or be allowed to get involved in would actually be implementing covered calls. Now, they would probably do this on individual stocks, but it would actually bleed over a little bit. There are volatility arbitrage plays between the volatility of individual stocks and index volatility. So there would be some downward pressure put on the call options that trade on the S&P 500, but not to the point of some sort of market efficiency, because not every institution is involved in that area. The other side of that, the put right, where if you do a cash secured put or a short put on an individual stock, you're selling the put option. You might be putting some downward pressure on the implied volatility and taking on the obligation to buy shares. It's a great way to get into individual stocks. It scares the bejesus out of a lot of people that, again, aren't overly familiar with the option market, or understanding what they're getting into, when all they're doing is really taking on the obligation to buy a stock that they want to buy. So the downward selling pressure on put options is even less than the selling pressure on call options throughout the overall market. And I think what results is what Greg's question states, that the put right has outperformed over time on a risk-adjusted and absolute basis, has outperformed the S&P 500. The buy right index, which is based on selling calls on the S&P 500, has outperformed on a risk-adjusted basis as well, but not as well as the put right index. So that's been my overall theory behind that, and I've stated that in front of some pretty smart academic guys, and I haven't really gotten any pushback yet. So we're not saying I'm right, but I might have a viable theory there on that one.
I think you're diving into some interesting waters, because you're right. I hear the BXM talked about a lot. I have a lot of people engage with us on the radio, on the website, inquiring about different aspects of the BXM and just covered calls in general. But I can probably count on one hand the number of times people have asked anything about the put right index over that same period. And I think part of that just has to do with what you're talking about. There's that general reluctance. These are obviously products aimed at the institutional / advisor / asset manager audience. And that audience still, for whatever reason, is still remarkably hesitant to really do simple things like use a short put as an alternative to a limit buy order in an equity. You think it would be a no-brainer? You think it would be much more preferable for them to do it that way because they have income coming in and going out, and yet for whatever reason, there are a lot of other external factors at work there that seem to be perhaps feeding back into the overall returns. I think it's an interesting question. I'm looking here at some of the numbers while you were talking, Russell, and it does talk about how overall the BXM and the put index both had vol that was 30% lower than the general SPX over the same time period, which is not surprising. But it doesn't mention the individual comparison between the two. I'll have to dig into this a little bit more and see exactly if I can kind of replicate exactly what Greg is talking about if I had the same kind of feeling about the returns over time than him. But overall you would think the put would probably generally outperform a little bit, even though you're right, you are writing the same exact at the money level of implied. So overall, it should be a very similar thing. But of course, you have much more capital efficiency on the put right side versus what you do on the covered call side. Of course, interest rates haven't exactly been that big of a driver of late, so that really shouldn't account for that much of a difference. So it really is an interesting topic. I'm glad you've had more time to study it than I have, Russell, so that you could.
It's one of our indexes, so it is definitely one of those things I get asked about a lot.
And it is a shame that more institutions aren't really diving into that, because that's kind of one of those no-brainer type products that they really should be doing this. In fact, we do a program on this network called the Advisor's Option, and we just ran through a bunch of what we think are the proper skill sets, what you'd reasonably expect from an options perspective for an advisor. And writing puts as an alternative to limit buy orders in the stocks was very high on that list, obviously. And yet, for whatever reason, far too few of them are actually doing that. So great question, Greg. I think we want to mull over that one a little bit more and look at some of the data, but I think it is kind of interesting. And I think, Russell, you may have actually come up with something there about the myriad obstacles and roadblocks that are in place on the institutional side and how that may be impacting the products. All right, last up here, we have a question from the Expert Magician, and he writes, "I just found you." Oh, so congratulations there, Mr. Expert Magician. You now have the joy of looking back over almost 3 years' worth of archives of this show to dive into, and I encourage you and all the other new listeners to do that. We have some fantastic guests on the program. In fact, I'd say the guest roster of this show pretty much surpasses anything else we've done on this network. Nobel laureates, expert practitioners, and academics in the world of volatility. So even if you don't want to hear the vol review for that particular period, the guests, I think, will certainly pique your interest. So check out the archives over there at theoptionsinsider.com. Expert Magician goes on to write, "Just started using volatility ETFs. Never used futures or options. What is the best way to learn about various ways to hedge S&P or Russell using VIX ETFs? Great podcast. I would love to see an RVX ETF. I think all of us would. Problem is with contango and contract roll exposure with ETFs. So I'm looking for a way to do this because I do not have the time to learn and actively trade futures or options." Well, Mr. Expert Magician, it's interesting you wrote into an options show about using ETFs in lieu of futures or options. I think most of us here on the program would probably lean the other way and encourage you to actually use the futures and or the options because they are indeed superior products for the reasons you just outlined. The problems with so many of these ETFs are that they rebalance on a daily or very, very near-term period, and as a result, they incur a ton of roll risk. And if you understand roll risk, and it sounds like you do, and you probably already have enough information to at least start trying your hand on some of these options. But we do focus mostly on the options side, so we don't run around with a lot of the great VIX ETF resources. Russell, do you have some suggestions here for our friend Mr. Expert Magician that fall on the ETF side of the fence?
Well, the VXX, which is issued by, I always get this wrong, so correct me if I'm wrong, is issued by iPath, correct? Or
Let me pull it up right now.
It's iPath or iShares. I
think it's
cannot.
iShares.
It's just one of those weird mental blocks.
It is iPath.
Okay.
Yes.
So the iPath website does a very good job of explaining exactly what's going on. iPath is owned by Barclays, and they explain what they refer to as roll yield. Yield can be negative, so that's their term for it. One of the things to
by the way, I
keep in
mean to
mind,
cut you off, but what a great euphemism for roll yield. If you call it yield, it must be good, right?
No, it can be a negative yield as well, but they call it roll yield, but it's typically roll cost. The VXX, which is when you're talking about the VIX ETNs, I mean that's it trades 20 million shares a day, and it's typically 95 to 99% of the daily volume. Just I think I'm probably overstating that, but that should get the point across. It is the one that everybody trades. The index that it is designed to follow involves rebalancing the futures every single day, and that shows up in the index that VXX follows. It's got a pretty complex name, but it's basically a VIX short-term futures index, and the index data actually goes back to 2006. So you can look at a what if on VXX during the 2008 period. And if you had bought VXX on the last day of September of 2008 and sold it on the last day of October of 2008, you'd have made 113%. So VXX does do what it's supposed to do when it's supposed to do it, which is give you exposure to some sort of spike in volatility. Unfortunately, you were mentioning the Russell futures coming out in kind of a quiet, the Russell volatility futures coming out in a relatively quiet volatility market. Well, poor VXX came out on a day that VIX closed at 50. So VIX has gone from 50 to 12, and VXX has had to encounter that, but then it also has to encounter that negative roll yield that occurs when the front month future is at a discount to the second month future, which has basically been about 95% of trading days since VXX was issued. But if you feel like there's going to be a volatility event in the next week or two, which is my polite term for an S&P 500 sell-off and a dramatic sell-off, there's nothing wrong with buying VXX or buying a call on VXX for a short-term hold, but it is not a buy and hold. I've yet to meet the person that says I've owned VXX for 18 months or anything like that. It's more of a short-term trading vehicle, and actually, it's a short-term trading vehicle, much like a short-dated option contract. If you buy a call option and it's an out-of-the-money call option, and the underlying market does not move or doesn't even move enough in your direction, you're going to experience some time decay. Well, you have to think of VXX the same way. You think of volatility events coming in the next 5 days. You buy VXX and VIX doesn't move an awful lot, you're going to lose some of the value of that VXX because of the same sort of theory.
Yeah, that's something we brought up on the show in the past. People have this perception for whatever reason that VXX is a buy and hold type product. We see a lot of people still coming in and trying to use it that way, and it's just not set up that way. But if you're right, if you have a very, very near-term outlook on a spike perhaps in volatility, and for whatever reason you're not comfortable buying a VIX upside call, let's say, then VXX is not a bad it's probably the best of a crappy bunch of alternatives. I think some guys on the show in the past have referred to VXX as predictably crappy. As long as it's predictable, kind of what you're getting into. And it is kind of nice that it is kind of the leading volume name, so that there is a lot of information out there if you want to dive into the roll risk. I don't care what they call it. I'm going to call it roll risk or roll cost. It certainly is not a yield in my book. There's a lot of various competing studies on that. I've seen some people saying it's upwards of 14% a month, the way they rebalance that product. So certainly that should give you some indication that that is not a buy and hold type product. If you can do it for a week or so, you're not going to really be too impacted by that. But if you're going to try to buy and hold VXX for a couple of months or even longer, certainly there are better ways to do it. But Mr. Expert Musician, I hope that touches on your question. At the end of the day, you did write into an options podcast. So let us again encourage you to familiarize yourself with even doing basic things like buying a VIX call, buying a VIX put, and see how that performs a little bit. I think you'll be overall much more impressed with how you use the direct products versus some of these ETPs on a derivative of a derivative. You're getting pretty far removed at that point. So I think you're probably better off over time informing yourself and starting to use the actual futures and options themselves. All right, that's going to do it for the Volatility voicemail segment. If you want to make your voices heard like everybody else on this segment, a lot of great ways to do that. Of course, you can post a comment on the website, theoptionsinsider.com, put it on the show notes for this show, and we'll route it to this program. Of course, you can shoot us an email, questions at theoptionsinsider.com. Just be sure to put in the subject line, question for Volatility Views, so we can route it to the right program. You can always find us on the social media, twitter.com/options, facebook.com/theoptionsinsider. And of course, the segment is Volatility Voicemail. I'd be remiss if I didn't mention we do want to hear your lovely voices. Leave us a voicemail, 773-669-4VOL. That's 4865. And leave us a voicemail, 30 seconds, maybe a minute, with your pressing options or volatility comment or question. And if it's interesting, we'll play it on the air. And now it's time to keep on rolling right on into our final segment, the Crystal Ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, and welcome to the Crystal Ball segment. This is, of course, a portion of the show where we attempt to peer into the future and kind of break down what we're expecting across the volatility landscape. And Russell, since you're the guest, I will give you pride of place here. What are you looking at? What are you kind of expecting for the week to come? A bit of a shortened week because of the Martin Luther King holiday, so only 4 real trading days. Are you expecting this kind of general, I guess you can call it, vol malaise to kind of continue, us to kind of linger in the low 12 range in the VIX cash for the foreseeable week, or do you think maybe some earnings might actually spark some life into the vol here?
I think some earnings might spike some life into the vol, and like you mentioned, we do have a short week, but on Wednesday, we get January expiration. Wednesday before the open, we've got United Technologies, U.S. Bancorp, and Abbott Labs reporting. Tuesday after the close, we've got IBM and Texas Instruments reporting. These are all very large companies that can have an influence on the S&P 500 index, which can in turn influence the option prices. So I'd be kind of cautious if I had a January VIX position as far as holding it through expiration. I'd always be cautious about that, but I would be extra cautious next week.
Good points, Russell. And of course, I'm going to look forward to seeing maybe if we see a few more blocks going up that could actually start some interesting activity in RVX, so we could actually start parsing here on the show and seeing what kind of these institutional clients are actually up to out there. And I'm really curious to see what kind of use cases they're really putting this product to, because for so long we've been so fixated on just the VIX realm and the VIX ETPs. It's nice to have, this is of course VIX related, but it's nice to have at least another product and perhaps another whole universe of ETPs that pop up coming down the road that we can kind of pay attention to and watch and kind of analyze some of the interrelations between this and the old VIX mothership product, if you will.
I was just going to say that is definitely a possibility. We get inquiries from some of the ETP providers about all the VIX futures that we trade, including RVX, and how they could go about creating products around that. So, an RVX ETP is not that far-fetched of an idea when you're starting to see volume trade in the derivatives. The other market, which has been kind of quiet as of late, but one that we get inquiries in, is the gold volatility market. So, don't be shocked if a gold volatility-related exchange-traded product comes out at some point.
People have been crossing their fingers for that one for a while, so that would be nice to actually see that hit the tape. And since we have been gassing on here for a while, Russell, and we are in the looking ahead mode anyway, why don't you go ahead and give our listeners a little bit of a tease of what they can expect either from you and what you're working on over there at the Options Institute, or indeed some interesting new products like perhaps the aforementioned gold volatility product that they can look forward to coming down the road from you guys over there at the CBOE.
Well, definitely the short-term volatility index futures and options. There will be an official launch date released in the next week or two. We should have our plans in place. I'm involved in, a meeting every once in a while where we're discussing where we are at with VXST futures and options. That's going to be a pretty interesting short-term product with expirations every Wednesday morning. And those expirations are going to be based on the S&P 500 index options that expire 9 days into the future. So we're going to have a consistent 9-day volatility product that has been a lot more volatile than VIX. The realized volatility on VXST over the past few years has been 175% annualized, where it's only been 109% annualized in VIX.
And, of course, if you want to learn more about Russell and the rest of the gang, what they have cooking over there at the newly revamped for 2014 Options Institute, then surf on over to CBOE.com, and you can click on all the Options Institute tabs and see what those guys have cooking. You guys have a lot of great free seminars, a lot of great just products, you guys have a lot of great free seminars and a lot of great free webinars and all kinds of great stuff you have cooking over there. So if you haven't checked it out, listeners, surf on over to CBOE.com. Check out the Options Institute tab for more on all the stuff we've been talking about today and all the different products we were hitting on today. And on behalf of Russell and, of course, myself, I want to thank all of you guys out there in the listening audience for welcoming VolViews back with such open arms. We're really excited to be back. Looking forward to many more episodes coming down the pike for you in 2014.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.